Good morning. Thank you for joining our webinar this morning. Maybe just wait a couple of minutes, a minute or so, just for some more attendees to come in, and then we'll kick off. All right. I think we can kick off today's webinar. So welcome to this 10x webinar, where we're going to provide an update on markets and fund performance. My name is Eddy, and I'm head of multi-asset funds at 10x Investments. There's been a lot of volatility in markets over the last couple of months, pretty much from about July, which can often cause concern for investors, for yourself, as you see really your balance fluctuate quite significantly over a relatively short space of time. So today we're going to unpack what's been happening in markets. We're then also going to look at what that has meant for portfolio performance and how, equally importantly, how 10x has performed relative to our peer groups and other investment opportunities that are out there for yourself. And then we will finish off by touching on a brief outlook and how our portfolios are currently positioned. And there'll certainly be some time for questions at the end of this. So we'll kind of look at about 30 to 35 minutes for the presentation, leaving some time for questions. So please do send through those questions as and when you have them. I will, however, only pick them up at the end of the presentation. So I'm going to plan to go through that. So yeah, let's kick off. I've got a PowerPoint, some slides to share that will support the conversation. So I'm just going to bring those up quickly. All right. So if we look at, and we kind of take a little bit of a step back and look at markets pretty much since the pandemic, the main driving force behind markets and the big theme has obviously been the return of inflation. So if you look at the chart on the left-hand side, we've plotted South African and US CPI, and what you can see is kind of through that 2022 period, that steep uptick in global inflation, driven both from first supply side constraints and then also sort of pent-up demand, really pushed inflation high. But that was very much kind of 2021 and 2022 story. The implication of that, however, is that we've seen one of the sharpest interest rate hiking cycles really going back in history. And you can see that on the chart on the right-hand side. We're showing both South African and US central bank rates. And those sharp interest rate hiking cycle that we've seen is really what has introduced volatility into markets over the last 18 months. But as you can see on the inflation chart, inflation's starting to moderate. We can see that in South Africa, the most recent print was at 5.4% for September. In the US, we had 3.7% in September, and actually the October print in US fell lower, close to 3% as well. So inflation's been moderating. And what that has meant is that we've seen central banks around the world really pause the interest rate hiking cycle from about the middle of this year, around June, July. And as that interest rate pressure has been easing, that's starting to pass through into a positioning in markets, and certainly them taking their foot off the accelerator and bringing a breather to that interest rate hiking cycle is certainly indication that the level of interest rates in the economy are certainly sufficient to tackle broader inflation. So higher interest rates are obviously great for savers as a whole because you earn much higher interest on your cash balances. However, they do have that impact of really limiting broader economic growth because you have the cost of debt is materially higher. So either as consumers, you have less disposable income, or as corporates, you invest less as your cost of capital is materially higher. In the US, we haven't seen interest rates bring headline GDP under pressure yet. But if you look back in history, every time you go through these sharp interest rate hiking cycles, broader growth certainly does take a knock. So it hasn't taken a knock yet, but all indications are that we are moving into a period of softer economic growth off the back of high interest rates. When we look at it from a South African perspective, we know we've had our own growth challenges in SA, whether that's from load shedding, which is over the last sort of 2 years really moving to sort of stage 8. It's got a little bit better more recently, but everything from load shedding to the issues at Transnet and our ability to move and export our commodities, which are a key component of our broader economy. And many of these structural issues are obviously inhibiting local growth. What's quite interesting, if you look at the chart on the left-hand side, we brought up a chart of South Africa's main commodity export basket. That's iron ore, gold, platinum group metals, and coal are our main exports. And actually, if you go and you compare that broader commodity chart with the inflation chart, commodity prices were one of the main drivers behind the elevated inflation that we saw in 2021 and 2022. But on the other hand, they really provided a big support to the broader South African economy because we earn a lot of hard currency for exporting those commodities. But as commodity prices have come under pressure over the last, call it the last 12 months, they've moderated quite materially. That's really led to a knock in South Africa's tax revenue. So we're in a position where we're earning lower tax as a government, primarily through the contribution of lower tax from corporate income tax from these mining businesses. At the same time, as we've got higher government spending, both through higher than agreed and budgeted for wage negotiations, but also a higher debt service costs, which obviously start crowding out government's ability to spend on service delivery. The net impact of really lower taxes and higher spending is that we need to borrow more money as a country. And you can see that that debt burden is starting to rise, and that's the chart on the right-hand side. The purple bar is the estimates at the February budget this year in 2023. And if we look at the most recent estimates from National Treasury, which came through in the medium-term budget policy statement in October or beginning of November, we can see obviously how that debt to GDP trajectory is certainly increasing. Now, we've spoken about how cash rates, which are really sort of tied to central bank rates, have risen quite significantly. But at the same time, we've also seen long bond yields increase. In a South African context, we've got the highest yield on 10-year government bonds going back to the early 2000s. And partly that's in response to the move higher in cash rates. But in SA's case, it's also effectively where that fiscal risk around sort of government finances expresses itself. So those higher South African government bond yields are really driven by that increased fiscal risk. And it's important to note that rising bond yields lead to declining prices in bonds. So as you see yields increase, the capital value of bonds decrease. So as an asset class or as an investor. In South Africa's case, because we've got quite high starting yields, the income that we earn from our bonds can actually offset the capital losses from those higher yields. But globally, so if we look at the chart on the right-hand side, we look at US 10-year Treasury yields. Well, when your starting income is pretty much zero, you had yield on 10-year US government bonds at about 0.5% in 2020. Well, as yields rise, and they have risen from about 0.5% all the way up to about 5%, there's no income to offset those capital losses. And actually, for what is the global risk-free asset class from the peak or the trough in interest rates, certainly in 2020. US Treasuries have lost about 45% in value. Now, if you compare that to what US stocks did in 2008, you can really see the quantum of losses from global fixed income, which is traditionally a defensive asset class. So that is in the rearview mirror. Where we are now is that we've got materially higher bond yields, both locally and offshore, which means that on a forward-looking return, the outlook for these asset classes are materially improved. You're able to earn 5% in dollars, locking that in, which is the highest that you've seen since kind of 2006, 2007. So super attractive. And equally, and from an SA perspective, highest yields on government bonds going back 20 years. So fixed income is certainly back, and the return opportunities there are relatively attractive. Now, often the US 10-year is considered sort of the global discount rate. And what we've seen over the last 18 months is that the move in bond yields has very much been driving move in equity returns. If you think about it, higher bond yield leads to a lower bond price, which obviously impacts, and those bond yields have been impacting equity valuations. So you've had bonds and equities sell off at the same time. Now, the reason that happens, if you think about it, for kind of all else being equal, if you have a higher bond yield, the future profits from equities are worth less today. So that's the role that interest rates play in driving equity valuations. But the key point that we really want to make from this chart is that the old dynamic of bonds diversifying equities hasn't held true over the last sort of 18 to 24 months. When you've had bond sell-off, equities have also sold off because you've had a higher yield leading to a lower equity valuation, and vice versa. As yields have come down, we've had equities rally. So what this has meant is that you've had increased volatility in your investments. And more so, if we talk to really the last 3 months from about July to October, you had the US 10-year move from about a 4% yield to about a 5% yield. And that really led to a sell-off in global bonds. And you can see that with the light blue line on the chart from about July to about October, you had bond prices sell off quite significantly. At the same time, global equities proxied by the S&P 500 also sold off in response to that increase in yield. So that's really been the dynamic that's been driving market volatility over the last couple of months. There is some good news, however, in that post the October month end, we've had bond yields fall quite significantly and equities rally as well. So that the current return and the realized return to broader asset classes and your portfolios have materially improved during the month of November, which is obviously a good outcome. Just got a chart on Rand and Rand volatility, because obviously often the Rand is really a barometer for how many of us and the broader economy, South African economic health, and often is highly correlated to how we feel from an economic and a wealth and just a general happiness perspective. So one thing I wanted to point out here is that actually, if we look on a rolling 12-month basis compared to the end of October last year, the Rand has been relatively flat. It's depreciated about 2%. But the amount of volatility over the last 12 months is significant. The range has been about 20%, from the lows of around about 1670 in January this year to the highs of about 1980 in May. So one needs to be careful around making any investment decisions in a knee-jerk manner as a result of significant currency strength or weakness because of the volatility that it brings. But I think as I'm going through the slide deck, I'm sure the one thing that starts standing out is we've had increased volatility in global fixed income, global equities, in the Rand as well. there's broader volatility in markets, and that's just part and parcel of investing as well. What that means, however, is if you are continuously looking at your investment balance, you can see a significant swing in value from one month to the next. And the only issue with that is, as long-term investors, as you stretch your time horizon out to sort of 3, 5, 10 years, that volatility really materially reduces. But what you don't want it to do is drive like knee-jerk reactions in response. And the classic case that one often sees there is, after a significant sell-off in equities, many investors panic and sell stocks or sell growth assets, locking in those losses. So very important to kind of match your time horizon and your investment plan with understanding how you invested. If you have a strong and a high allocation to growth assets like equities, well, you're going to have a volatile ride, but you are going to have higher returns over the longer term. Markets really bottomed in October 22. So on a 12-month basis, equities have actually been up quite strongly, which is quite pleasing, despite the softer returns we felt over the last 2 to 3 months. And you can see there's significant volatility depending on where you've been invested. Take China, for instance. In Rand terms, China was up about 50% just from October last year to the end of January. And since then, it's really been moderating quite materially. Whereas South African equities and broader EM were also up strongly at the beginning of the year, and then have subsequently been relatively flat since then. Whereas global developed markets equities started the year relatively softly, and then through sort of March, April, May, as you kind of had a lot of the strong earnings coming through from the tech sector in the US, that certainly supported broader S&P 500 and global developed markets as a whole. I've just highlighted on the chart there the period following October month end, just to show you how broad equities across the board, whether that's SA equities, whether that's emerging markets, whether that's US, have really been up about 8 to 10% since the end of October. So again, we've recovered many of those losses experienced in the preceding 3 months. From a broader asset class return perspective, we're looking at returns to the end of October. So remember, I've said that returns have materially improved in the month to date, and the November numbers will look a lot better. But it's interesting just to pull out, if we look at the 3-month asset class returns, really sort of that saying that cash has been king has been true, because we've had both bonds and equity sell off at the same time. So on a 3-month basis, it's only been SA cash and global cash which has delivered positive returns. Obviously, global asset classes are supported by currency depreciation as well. But as we stretch that time horizon out slightly longer to kind of a 1-year basis, we can see that growth assets, barring SA property, have delivered pleasing returns. SA equity roughly broadly in line with inflation, but those offshore asset class returns and growth asset returns like DM equity and EM equity really driving portfolio returns over a 1-year basis. As we look at portfolio returns, here we've pulled up 3 of our main portfolios that clients are invested in. The 10x Your Future Fund, that is the main portfolio that most pre-retirement investors are in. So whether you're in an RA, a preservation fund, the umbrella fund, that is where we find most of our investors allocate their money. It's our high growth long-term portfolio. For those of you that are invested in the living annuity, we also have 2 additional international options. Obviously, a living annuity is not regulated by Regulation 28, which limits offshore exposure to 45%. International high equity and international medium equity portfolios are those portfolios which have more than that 45% limit offshore. And what you can see is, despite the short-term volatility that we've seen over the last 3 months, the 1-year returns are pleasing across the board. 8.7% for the 10x Your Future Fund, 11% for international high equity, 7.8% for international medium equity. And as we stretch those time horizons out, and this is really the key, investing in high growth portfolios is really the right way to create wealth over the longer term. You can see those 3-year, 5-year, 10-year, and 15-year numbers that have really been materially higher than the returns you would have received investing in a money market or investing in a really low risk defensive type portfolio. So there's a lot more volatility if you're investing for growth, but it comes with the reward over the longer term. From a peer performance perspective, we have compared our 10x Your Future Fund, and here we've taken a Class A unit trust, and we've compared that to all the other large balanced funds in the high equity category in South Africa. And absolute performance is important because that's what drives your outcome and drives your wealth. But you also have a decision in terms of where you want to be investing your money, with which provider. And what you can see is with the 10x Your Future Fund, compared to all the other balanced funds in the country, which have a similar mandate and targeting a similar outcome, we've delivered consistent outperformance that has been materially above that broader peer group average. So you can see over the last year, it's been a 2.2% outperformance, and that ranges from about 1.2% over 5 years, and that's per annum, all the way to that 2.2% per annum over 15 years. So really been generating pleasing long-term returns in absolute and also relative to our peer groups. So a good outcome as 10x investors. So that's kind of looking at performance. There's always going to be a lot of short-term volatility, but it is important to look over that longer-term time horizon. In terms of an outlook, what we brought up at the chart here is we're really looking at the current market environment, current yields on fixed income, current valuations in terms of equities, and saying from this starting point, what is the return outlook for these asset classes over the longer term? And there are really two key call-outs here. The one is looking at the returns to fixed income. So if you look at sort of South African bonds, the high yields on offer from South African bonds are saying from this point, looking out over the next 10 years, one will be able to generate returns of around 6 to 7% above inflation from the starting point. Those are equity-like returns from a defensive asset class like bonds. So it really talks to how fixed income is back as an asset class and actually how you can generate relatively high returns whilst being still relatively conservatively positioned. So we've got the longer term average for each asset class on the chart, and then the blue bar is kind of the current forward-looking return expectations. And what you can see actually for most asset classes, barring developed market and primarily US equities, the return outlook is actually quite attractive from this point in time. However, looking primarily at US equities, and we've seen a significant sort of tech rally, you might have heard of the Magnificent Seven. It's a high concentration of about 30% of the US equity market is sitting at about 7 stocks, very much sitting on relatively elevated valuations. There's kind of a lot of euphoria around AI and what that means for these businesses. But what you can see is that the return outlook primarily for the US equity market is much lower than where it's been over the longer term. And equally, in an offshore sense, you are able to really invest in global bonds that are set to deliver returns that are roughly in line with broader US equities. So again, the ability to build portfolios with higher allocations to defensive assets that will still deliver on the return outcomes that we're looking to deliver on and generate that at much lower risk. So the outlook barring US equities is certainly a lot more attractive. And that's been off the back of the significant increase in yields that we've seen over the last 18 to 24 months. So from a portfolio positioning perspective, the 10x Your Future Fund is certainly slightly more defensively positioned. And when we say that, there's a much higher allocation to defensive asset classes like fixed income. We have about 20% sitting in South African bonds, so that's across South African nominal and inflation-linked bonds. Obviously, with inflation-linked bonds, you are getting sort of real returns of around inflation plus 5, and you're removing the inflation risk associated with potentially a poorer fiscal outcome from a South African perspective. And there's about 7% allocated to global bonds, primarily in the US Treasury market across both TIPS and nominal bonds. So we've got 27% sitting in fixed income. That's the asset class that's obviously the most attractive on a relative basis for us. And what that has meant is our ability to deliver on the outcome of these portfolios using and allocating to a higher proportion to fixed income has meant that our split between growth assets and defensive assets is lower than what we would expect through the cycle. Through the cycle, that would be sitting at about 75%, and we're currently sitting with a 66% allocation to growth assets. So more conservatively positioned, but without foregoing really the return opportunities because of the outlook for global fixed income. The other point to make is from a local versus offshore perspective. We've got 41% allocated to offshore assets. So that's quite close to the 45% max. We certainly believe in global diversification as a key risk mitigation tool. The reason why we're not quite at that 45% level is really due to the return opportunity on offer in local fixed income. So really summarizing there, from a portfolio perspective, from an outlook perspective, the outlook for global fixed income, for local fixed income off the back of materially higher yields are a lot more attractive. As a result, we've got a much higher allocation to those asset classes within our portfolios. However, one still needs to remember that if you are investing in a high growth portfolio, the expectation is that you will have significant volatility along the way. But the trade-off is that over the longer term, you can expect to deliver and receive a much higher return above inflation. You could go the route of investing more conservatively. You'll have a lot less volatility. You'll sleep better on a night-to-night basis. But the trade-off there is that your longer-term return is going to be materially lower, and that might not necessarily fund your investment goals, whether that be a specific drawdown in a living annuity. I think the most important part is to acknowledge how you are invested and what trade-off you are making. If you are invested for growth, know that you are going to have volatility. Most importantly, don't panic if there is volatility, and try to ride that out so you can enjoy the higher longer-term returns, because the biggest and the quickest route to wealth destruction is obviously switching out of a high-growth portfolio once it has already sold off. So given the fact that interest rates are quite elevated, I think one can expect this volatility to continue over the coming months and into next year. So it's really important to stick with your plan. If you think you are going to panic, if markets sell off materially, maybe it is better to remain invested in a slightly lower risk portfolio, even if your longer term outcome is going to be potentially worse off, because if it means it keeps you invested and you don't panic and switch, ultimately that'll lead to a better outcome from your investing perspective. So that's a quick overview in terms of what's been happening in markets, an outlook, and also from our current portfolio positioning perspective, how we're sitting. I can see a couple of questions have come through. One from David, thank you. So David asks, especially in light of the correlation between equities and bonds, are you considering introducing alternative assets into your multi-asset fund in order to try reduce the volatility? For those drawing income, high drawdowns can materially affect your longer-term outcomes. That's spot on, David. So if you are drawing income, those high drawdowns in asset values can materially affect your longer term outcomes, but equally being invested too conservatively can also impact your longer term outcomes. So there needs to be a trade-off. When it comes to alternative investments, we, from a cost benefit perspective, we don't necessarily see that they add material benefit. They don't always deliver on what's on the tin as well, especially in an environment where you have correlations moving to one. Often with many alternative investments, you hope that they'll diversify, but if you go to a 2008 type environment where you had correlations moving to one, often many of those alternative asset classes didn't deliver on their diversification promise, but what they do have is materially higher costs. So we certainly are cognizant of that. What I will say, however, in terms of how we are building our portfolios, as I mentioned, is that we're actually able to utilize fixed income now at these much higher starting levels to deliver equity-like return into the portfolios. So we've actually brought down the total level of risk in terms of the growth asset allocation. We're more conservatively positioned, but without foregoing the return opportunity and the outcome that we need to deliver across our multi-asset portfolios. So thanks for that question, David. See, Chloe's got another question where she's saying she needs to make a lump sum into an annual tax-free saving contribution before the next tax year, which is the end of February. Which month leading up to next year would be best to make this contribution, as I see the trend seems to be downhill, or should I wait it out to next year? Chloe, from a market timing perspective, and certainly we don't provide financial advice, but from a market timing perspective, over a short-term time period between now and February, there's 3 months. Anything can happen over that. In what we often see some clients doing to potentially try and mitigate that risk of significant volatility is they'll spread that contribution out over a couple of months. So if this month is up and next month is down, on average, you're kind of getting into the market at a much more smooth level, and some of your contributions will benefit from that and some of them won't. So potentially that's an approach, but certainly not financial advice. From Harold, there's a question asking, given the mandate of your future fund, why not a larger allocation to growth assets? The moderate funds cater for volatility. Thanks for that question, Harold. So through the cycle, we would see growth asset allocation of about 75%. We've got a range of about 65% to about 80% in terms of the range that those growth assets could be. So at 66%, we very much are at the lower allocation to growth assets. And that's primarily driven by a lower allocation to developed market equities and US equities. So we've got quite a high allocation to emerging market equities. We are at our allocation to SA equities of about 36%. And it's really based on the forward-looking return outlook and the valuation specifically impacting US equities and broader developed market equities. It's that part of our fund that is slightly more reduced. And equally, we're able to earn equity-like returns from SA fixed income of around about inflation plus 6 to 7%. So through that lens, in terms of generating an inflation plus 5.5% a return outlook over a rolling 5-year time period, we're actually able to allocate to these fixed income asset classes which are delivering equity-like returns. So it's really a function of the return outlook from broader asset classes mirrored with the outcome that we're looking to deliver for the future fund. So we really are quite fortunate that we're at an opportunity where we can deliver those equity-like returns by investing in fixed income. And so that is really kind of the reason why we are sitting with a lower allocation to growth assets. And that allocation process is consistent even across the moderate funds. So within our moderate funds and our defensive funds, we also are sitting with a lower allocation to growth assets, because we can deliver equity-like returns through investing in fixed income. There's another question from Edmund asking, I understand that the US debt has reached an all-time high, employment has slowed, and all indicators are pointing towards a recession in the US. I think you also said high interest rates have not impacted US GDP yet. What will the impact for SA over the next 6 to 12 months be? Well, Edmund, that is, so let's take a step back and just say, if the US moves into a broader recession, we know they're saying that sort of, if the US sneezes, the world catches a cold. Because they are the biggest economy and a main driving force in the global economy, the US enters a recession that has knock-on impacts in terms of the global economic growth. And as a result, you can think about what are the drivers for South African GDP. Well, commodity cycle is quite important. In a recession, commodity prices typically come under pressure. There are this broader risk off, where emerging market assets are typically sold off, and money moves from sort of riskier assets to more defensive assets like US treasuries and back into the US dollar. So if the US does go into a recession, the outlook isn't great for the rest of the year. But I think the key is to say, well, let's separate out the economic impact from the asset market impact. And if we look at those two, given what yields have done, and we've gone on about this quite a few times, but it really is quite key. The yields on offer in SA and in the US means that the return outlooks from those defensive asset classes are the best they've been in 15 to 20 years. So that's a great place, whether we move into a recession or not, to allocate to. Because if you move into a recession, typically yields materially fall down, and you get a capital gain on your bonds together with those starting income, with the high levels of starting income. And if we don't go into a recession, well, you earn the high levels of starting income. Let's say rates stay where they are and they don't come down. That's, again, a great outcome. Whereas from the equity market perspective, global equities, ex-US, South African equities, emerging market equities are actually at relatively fair or attractive valuations. So sure, if there's a broader global recession, those asset classes will take a knock. But coming out of that, because the expectations around earnings for those asset classes are not demanding, they should do well coming out of a broader recession. Whereas from US equity markets, the expectations baked into US equities at this point is that, number one, earnings growth over the next 12 months and actually over the next 2 years are sitting at 12% year on year, which, if one goes into a recession, earnings growth for US equities will certainly come under pressure. So you might have US equities as a whole miss earnings, but equally, they are at quite an elevated valuation compared to where they've been over the longer term. So the market expectation is that those earnings will continue to grow in future. So there's this disconnect between both valuations and what happens to earnings expectations in a US recession, which means that US equities for us, whether or not we go into a recession, are kind of pricing perfection, whereas there's a large margin of safety in other growth asset classes. Hazel's got a question around the 10x moderate portfolio. Hazel, we have the fact sheets available on our website. On a peer basis, we've seen similar significant outperformance relative to the peers. It's also delivered quite pleasing returns over the last year and 3 years. We didn't bring it into this presentation because most of our investors are all focused on the future fund and then the two living annuity international options. But you can certainly reach out to us or go onto the website and you'll be able to see the returns from the moderate portfolio. But roughly in line with similar outcomes to the future fund. just with slightly lower returns, obviously, because there's a lower allocation to growth assets. So that seems like all the questions. If you do have any more, please do send them through. But personally, from myself and the broader 10X team, thank you for joining us this morning. More importantly, thank you for entrusting us with your savings. It's something that we really are honored to be in the position where we can work with you and help you grow your wealth. We'll continue to keep you updated in terms of portfolio performance, how we positioned. But the key takeaway, and I'm sure if you've spoken to any of our consultants, they'll say the same thing, is you need to set your plan in terms of your long-term investment goals. Stick to that investment strategy and try not to panic if there is volatility over the shorter term. Investing for growth assets, if you think about what we've gone through over the last 3, 4, 5 years, everything that's happened. Every year there's volatility when it comes to investing. Very seldomly do stocks go up in a straight line. So it's part and parcel of investing. You've got to stick with your plan, manage your emotions, understand how your investments will perform in different type of environments, and obviously how that's then linked to the long-term outcome that you can expect. So thank you very much for joining us today. I'm sure the team will make a recording of the webinar available if you have missed it, or if you want to share it with any of your friends or other clients that you know. So we will make that available. But again, thank you for joining us today, and I wish you a good festive season coming up as we're getting into the December period. Stay safe, stay healthy, and keep well. Thank you.